Welcome to Goldstone Finvest. I'm Prabhat Majumdar. I would share March monthly overview. Looking at the March monthly overview, the year ended far better than it began. As the economy and markets recovered after May 2020 with a gradual easing of lockdowns. Corporate India surmounted the challenges posed by COVID with unprecedented cost containment measures with a parallel improvement in the balance sheet as well as cash flows. March 2021 saw index witnessing sharp swings on both the sides. Such whipsaw moves contributed to nervousness among the market participants as previous market leaders, outperformers retreated. Broader inter-market analysis indicated that participants are finding options away from equities as volatility inched higher. Moreover, Bank Nifty's underperformance restricted any meaningful convincing rally in Nifty. Also, different asset classes, that is bonds and gold, are now attempting comeback against the equities. The market sentiment was mainly guided by the infrastructure stimulus of $2.3 trillion announced by the US President Joe Biden. The Treasury yields also witnessed some pullback which led to the movement in stocks. Indian markets were mainly stuck in a range and there weren't any specific local macros guiding India's benchmark indices. It was more of a volatility squeeze. The financial year 2021 ended on a positive note for Indian equities with benchmarks the Sensex and the Nifty jumping 68% and 71% respectively during the year. The BSE mid-cap surged 91% while the small cap index gained a whopping 115%. The cumulative market capitalization MCAP of BSE listed firms is at more than Rs 205 lakh crore, a rise of about 92% in FY21. On March 31, 2020, the market capitalization of BSE listed firms stood at Rs 113.5 lakh crore, data available with BSE showed. Last month saw Nifty going through a corrective move. Despite choppy activity of last few weeks, we believe medium-term low is firmly in place. Anniversary dates more often result in the formation of tops and bottoms, either minor or significant. A year earlier, around March 24, the benchmark index marked a bottom of 7,511, a low which was never breached thereafter. This time around, that is March 25, 2021, Nifty made yet another low of 14,264. Anniversary dates invariably trigger remarkable high or low swings. Recent recovery has brought an end to phase of decline. Meanwhile, ratio of US 10-year bond versus S&P 500 and emerging markets is reversing after creating a base at the bottom. It highlights underperformance of both S&P 500s and EMs. Similar scenario is playing out back home too as ratio of Nifty GS. Gains of around 2.5% in benchmark index this truncated week has provided some respite to beleaguered bulls, yet Nifty is facing multiple headwinds which are likely to come into play in coming weeks. Presence of three-digit GAN number of 151 and multiple peaks seen in the month of March 2021 around 15,300 are likely to restrict upside moves. Corrections are an important part of any uptrending index. It should not be aligned in same bracket as a change in structure. Composite index versus Nifty has bounced off from the bottom, implying that bonds are outpacing equities as of now. So we are unlikely to see any runaway moves in Nifty. Among the sectors, rotation is clearly in play as banks have been on the back foot and underperforming, while defensives, that is FMCG and pharma, have made a strong comeback. Ratio of FMCG index versus Nifty is bouncing off multi-year support zone. Positive follow-through is likely to result in outperformance from FMCG space in medium term. Nifty IT stocks were among the major movers in month of March, showing resilience. Ratio has bounced off point of polarity zone and moving higher with support of its 200 DMA. Experts expect IT stocks to outperform against the benchmark index. Meanwhile, metal stocks are showing bullish patterns, ignoring recent up move in the US dollar index. Since October 2020, it has seen that corrective moves in ratio have been for shorter duration. Recently, it managed to surpass 200 weekly EMA, which implies continuation of outperformance of metal against Nifty. Theme which has made a strong comeback has been mid-caps. Nifty Mid-Cap 100 Index has outpaced Nifty in last two sessions. On standalone point and figure P&F chart, it has staged a low pole reversal and double top breakout. Recent recovery in this index is aided with reversal in mid-cap breadth, implying strength within mid-caps. Small and mid-cap stocks were laggards for a few years pre-COVID and picked steam only when markets switched towards value plays. Going forward, there seems to be a lot of fuel left in them, as some of them are still quality, growth-oriented stocks that can undergo a re-rating in terms of valuations. Stock picking will now come into play, as there are certain bets which have the potential to gain alpha. IT stocks have led the rally due to a combination of factors such as the appreciating dollar and expected positive upcoming quarterly results. Besides, defensive stocks are gaining more traction with the risk of the second COVID-19 wave and lockdown. Indian IT companies are fundamentally strong with stable earnings growth, quality management, pipeline of strong deals and consistent cash flows. On the other hand, the uptick in economic activity is leading to a rally in basic material stock. The IT sector is likely to continue this outperformance in April as well. Realty stocks have witnessed some correction after a strong rally, which is a part of the game. Corrections are much needed for a healthy market rally. On the other hand, telecom stocks have underperformed due to financial stress and companies refraining from tariff hikes. Any development in the telecom sector will dictate its trend in April. Volatility is likely to continue in the month of April as Nifty continues to consolidate in a range of 14,260 to 14,880. Any break from the immediate range can dictate Nifty's course in April. However, we do maintain a mildly bullish outcome given the approaching result season. The first half of this fiscal could see some volatility because of the previous year's low base due to lockdowns, and the latter half of the year might see a different picture. Hence, the returns could be moderated on an overall basis and aren't expected to be as large as FY21. Investors can therefore place their investments in quality economic driven stocks which can continue to move higher. If anything, FY21 has taught us that investors could stay invested through the thick and thins of the market as the rally can continue. Investors can keep a 5 to 7 years investment horizon to beat the volatility that the coming year can bring us. RBI's MPC meet and the governor's comments on the overall economic scenario will dominate the bourses in the week ahead, followed by the result session which is expected to commence for this quarter. Investors may buy defensive such as IT and FMCG, which are expected to post better earnings growth this result season. The pace of vaccination and the trajectory of quarterly earnings will drive the market in FY22. Given the recent resurgence in COVID-19 cases, the pace of vaccination will assume crucial importance. Expeditious containment of COVID-19 cases and accelerated pace of vaccination will provide comfort for FY22 economic growth recovery. The expectation for FY22 earnings are running high at more than 30% in growth in Nifty FY22. Given the rich valuation, any misses on FY22 earnings delivery may act as a dampener. As stated by Goldstone experts, traders should trade extremely cautiously with strict stop losses and should follow support and resistance levels on strict basis. Follow support and resistance levels along with trading call as published on our Telegram channel. For regular updates, like, share and subscribe our YouTube and Telegram channel. Also follow us on Twitter and Instagram and also be a part of our Facebook family. Views by Goldstone Finvest. Let's build fortune together.